silver at the end of the year at $96, it would not be crazy at all. And if you take 42.40 and divide by 7, it's going to be somewhere around $600, 605. As insane as that sounds, that would match the geologic footprint right now. So yeah, I think silver is the asset of a generation. The rumor is the reason they stopped is there's one big trader who took possession and would not roll it over a stamp for cash delivery. Perhaps an Asian trader who wanted over 400 million ounces of silver. Give it to me. And so, all of a sudden, the cooling breaks down over Thanksgiving in one of the most thinly traded markets of all. So there's virtually no activity, but just those servers broke down. Right. And China, second largest producer in the world, is flying to Peru and Mexico and buying doré and concentrate, paying twice what the rest of the world will, and ship it back to refine it. If they're the second largest producer, then why the hell are they doing that? Because it's worth far more than the currency used to buy it. All roads lead to the same place, and that's Shanghai, which becomes the price mechanism for physical silver. It will take over for the COMEX. But 2 days into the December delivery month, and there's already been 23,970 gold contracts that have stood for delivery. That's 2.397 million ounces, and plus 8,305 silver contracts, or 41,525,000 troy ounces issued and stopped so far, and the month has just started. It's also relevant to note that in November, which I would say was not normal, the silver deliveries ended the month at just under 20 million ounces, about 19.7 million, which it's really crazy because November is not a scheduled delivery month for either silver or gold. There was 1,267,000 ounces of gold delivered. Issued and stopped is the correct terminology. But you know, the first day, this month, the December contract, day one, we saw 7,330 contracts stand for delivery in silver, which is 36, almost 37 million. That's more than $2 billion worth. And although it's not a record, it's close to it. April was the biggest record of just under 12,000 contracts. But to see a 2-day, you know, that's day one, and 2-day obviously added more, but it's just insanity, where there's already been 2.4 million ounces of gold and almost 42 million ounces of silver delivered in 2 days. This is the same type of volume that we've seen all year long. And
2 days into December are already rewriting the rules of gold and silver deliveries. Experts often downplay these early surges, but the numbers tell a different story. Nearly 2.4 million ounces of gold and over 41 million ounces of silver have stood for delivery, and November alone saw 19.7 million ounces of silver delivered in a non-scheduled month. Andy Schectman has repeatedly warned that these volumes signal a market under strain. Investors should note that the speed and scale here are not anomalies. They indicate systemic pressure building across COMEX and LBMA networks. The implications for portfolios are significant. Physical metals demand is surging while derivative markets are showing strain. Next, we'll see why mainstream commentary rarely flags the real-time depletion risk in precious metals.
you know, it's funny, you and I started talking about this in 2020 before anyone did, and now it's just mainstream, and well, mainstream in our business. And I think this will continue until it doesn't, meaning until stuff is just depleted and it's becoming more and more obvious that this is an imminent deal. At the same time, you have one of, if not the largest short position in COMEX futures market, you know, along with a massive short position in SLV, one of the largest ever. And at the same time, you have the LBMA, which is running on fumes. And, you know, it's a situation where the delivery via mechanisms are breaking down. Almost 90 million ounces have been delivered off of COMEX this year, and or excuse me, since October, pardon me. And I don't know, since October 1st, 90 million, it's accelerating at a level that I don't think people understand or take for granted. And I think the way that you break that up is just to simply say that, let's make an analogy, right? For years, everyone pretended that, let's call it a cardboard box was full of cookies. There's a picture of a cookie on the outside. And the thing of it, and they would trade that. But
Market mainstream finally acknowledges what insiders saw in 2020, but the scale of short positions still surprises. COMEX and SLV hold some of the largest shorts ever recorded, while the LBMA shows signs of stress. Nearly 90 million ounces delivered since October indicates a rapid depletion of available physical metals. As Andy Schectman highlights, investors often miss the acceleration in real deliveries compared to what's assumed in futures. The cookie analogy underscores a structural flaw. Derivatives mask actual availability, leaving portfolios exposed to real-world scarcity. Next, we'll examine how these pressures expose cracks in trust and price discovery mechanisms across global metals markets.
now everyone is saying, no, I want the cookies. And people are realizing that the box is pretty much empty. And when that happens, this pretend cookie game, which you could call the derivatives, falls apart. And real cookies, gold and silver, become much more valuable. And that's why prices are rising. And why the dollar and other currencies may look weak when the truth comes out. So yeah, I think it's a big deal. There was this report that JP Morgan shifted its offices to Asia in the middle of the night, that they were told that the people had like 5 days to move their family and everything to Singapore. I believe that is false. So everything that I'm reading tells me that that's not true. I guess we'll find out and we will see, but I know a lot of people have been asking about that. The bottom line, then again, to me, is that the market runs on trust. And when you believe that you'll get delivery of what you were promised, and that trust has been built up over decades, then the system works. And you buy a contract, you can stand for delivery. The metal's there. That's why COMEX has set the price of gold and silver forever.
The derivative market illusion is collapsing as real demand for gold and silver surges. Despite sensationalist reports about JP Morgan moving offices overnight, most evidence suggests the rumors are false. Yet investor concern reflects the fragility of trust. Long-term investors should note that decades of market trust underpin COMEX and LBMA pricing, and breaches in that trust can trigger accelerated price movements. This is not hype. It's structural reality, with real metals asserting dominance over paper contracts. Next, we'll explore how technical failures reveal deeper cracks in the metals market infrastructure.
And the analogy is like a bridge that handles a whole bunch of weight until it doesn't, like the 35W bridge in Minnesota that collapsed that I drove over 5 million times. And you're seeing that in London. You're seeing that in the COMEX now. And I don't know, I think that this is going to be a story that gains a lot of traction over the coming weeks and months. I think that the price of silver is just beginning. I really, truly, truly do. And that nonsense of a outage, a glitch and an outage of air conditioning at the CME, a cooling failure, is a bunch of crap, because only the metals markets went down. You know, the other CME markets, like the bonds and the FX and the repo and the equity futures, well, they stayed online. It was a technical failure isolated to only one asset class and low volume that day, yet the whole thing went down. To me, it just is telling you that things are breaking. And I don't know, I think that this is just the beginning. We saw 12.5 million ounces were transferred out of the COMEX registered category on November 26th. So, you know, where's it going? Who's buying it? How caught are they? These are the things that I would be focusing on right now. To me, that's the most important thing to talk about today.
Supposed CME cooling failure was far from an ordinary technical glitch. It highlights systemic stress in metals-only infrastructure. While bonds, FX, and equities remained operational, COMEX's metal systems faltered, coinciding with 12.5 million ounces leaving the registered category on November 26. As experts like Andy Schectman note, this points to concentrated physical demand outpacing technical capacity. Investors should view this as a signal that market structure itself may be contributing to price volatility. Next, we'll analyze what this means for the shift of global price discovery away from traditional Western exchanges.
Your comment about the COMEX reminds me of what happened during the nickel market run-up a couple of years ago. Our mutual friend, our dear departed David Smith, talked to us about that at the time and said, this is a private club. They can change the rules anytime they want. It reminds me of George Carlin's statement that it's a big club and you're not in it. But any comments that you have about the fact that on Friday, when silver was breaking out to a new all-time high monthly close, that's when all this shenanigans seemed to happen, when the trading was halted for 11 hours on the COMEX. Any comments from you about that?
I would just simply say that if a market loses trust in how prices are discovered, or if it can quickly shift the rules, so too will the price discovery. Will shift elsewhere. And to me, all roads lead to the same place, and that's Shanghai, which becomes the price mechanism for physical silver. It will take over for the COMEX. And, when you play these games, we've seen it now in London with the nickel market. We're seeing it here. It's what they did to the Hunt brothers. They changed the rules. They'll raise margin requirements. They'll do all of these things.
The 11-hour COMEX halt during silver's all-time high is a stark reminder of the control mechanisms elite players can exert. Historical context, like the nickel market surge and the Hunt brothers' manipulation saga, shows how quickly rules can be rewritten to favor insiders. As Andy Schectman highlighted, this is essentially a private club where trust is fragile. Investors should anticipate that price discovery may migrate to Shanghai, reflecting the rising importance of Asia in tangible metals markets. Next, we'll examine how systemic trust failures are shaping the global shift in silver pricing.
But when you end up seeing, when you end up seeing a failure of trust, a massive breakdown in trust, I believe that shift will happen. And, it will kind of be like London losing its grip on oil pricing, and move to the NYMEX. And, they ran it for a long time. Now they're an afterthought. The same thing will happen here, I believe, that the world will be so angered, if you will, by the fact that this has been a game that has been played for a long time by the West, that it will move to the part of the world that, the center of gravity will move towards Asia, I guess is what I'm trying to say. So, yeah, I think that's going to happen. I don't know when, but ultimately, in a world of probabilities, I'd put a high level of certainty on that at some point, it just moves to the part of the world that is cash and carry instead of promises and rehypothecation. In other words, you buy in Asia, you pay your money, you get your bars, and out you go. And before you buy it, you have to buy a bar from one of the pre-approved refineries, and they laser etch the number of the contract that you have on that bar. There is no shenanigans there. It's all about shenanigans here in the West.
Investor frustration with opaque Western markets is pushing physical silver demand toward Asia, where cash and carry practices dominate. Unlike COMEX or LBMA, buyers pay, receive, and verify their bars with laser-etched contracts, eliminating derivative games. Historically, when London lost control of oil pricing to NYMEX, global markets adapted similarly. Experts like Andy Schectman argue that the silver market could experience a structural migration, making Asia the de facto global price setter. Next, we'll explore how this shift underpins the recent surge in retail and institutional physical demand.
How about any comments from you? You already mentioned that this increasing demand because of people wanting the real goods, wanting the real article, the genuine article, is a underpinning that is really providing a floor underneath an increasing demand for physical metals, as evidenced by off-taking from the exchanges and so on. Any comments from you on silver's resulting breakout, which you did mention the price? If you watch the prices, that's really something that's an after effect. It's the tail that's being wagged by the dog of the real physical demand. But any comments from you on either the price action recently or going into the end of the year, or physical availability of metals in the retail space?
Well, it's interesting. The technical analysis would say you take the cup and handle when it breaks through the handle, which it has at over $50, that you take the top of the cup in 1980, which was 50, the bottom of the cup, which was $4 in the 90s, and the difference is 46. You add it to the top, and that would say $96 would be the next technical resistance level, if any, or that would be the projected next place to go.
Retail and institutional silver demand is the real engine behind price movements, not short-term speculative swings. Offtake from exchanges confirms that the market's tail is being wagged by physical metal demand, and technical analysis supports a projected $96 resistance level based on the 1980 cup and handle formation. As Andy Schectman notes, this price action reflects real-world scarcity, meaning portfolios exposed to paper silver may underestimate risk. Investors should treat recent breakouts as the early signals of a deeper structural shift. Next, we'll see why these ratios suggest even more extreme upside potential if current trends persist.
And if you take a 42-to-1 ratio right now, or even call it 45-to-1, where it's averaged for the last 100 years, the silver to gold ratio, even though it's been coming out of the ground for 5,000 years, it's 16-to-1, and now it's 7-to-1, meaning it's depleting in nature. The price ratio, largely because of, in the Western world, gold's role as a monetary metal and silver's role in industry, it's average about 45-to-1. So you take gold today at 42.40 and divide by 45, and what do you get? 42.40 divided by 45 is $95. Well, isn't that interesting? That would be where it would tell you to go, where you take the top minus the bottom, which is 46, add it to the top, that would say $96. So, I mean, if you were to see silver at the end of the year at $96, it would not be crazy at all. And if you take 42.40 and divide by 7, it's going to be somewhere around $600, 605. As insane as that sounds, that would match the geologic footprint right now. So yeah, I think silver is the asset of a generation. And I want to always hammer it home. I'm not telling people to buy it to become wealthy. It is wealth.
The silver to gold ratio signals a market anomaly few are acknowledging, yet the math is undeniable. Using historical averages of 45-to-1, silver should trade near $95, and current depletion could theoretically push it towards $600 based on a 7-1 geological ratio. As Andy Schectman emphasizes, this isn't speculation. It's a structural mismatch between price and underlying scarcity. Investors must see silver as intrinsic wealth, not merely a speculative asset. Next, we'll explore how this structural mispricing may accelerate institutional and sovereign accumulation globally.
And the biggest money in the world is showing you that. The sovereign wealth funds and the central banks, who have now largely reclassified silver a critical mineral. The U.S. government has. The EU did it in 2023. China just did it, and they are restricting exports. And China, as we've said ad nauseum on your show, the second largest producer in the world, is flying to Peru and Mexico and buying doré and concentrate, paying twice what the rest of the world will, and ship it back to refine it. If they're the second largest producer, then why the hell are they doing that? Because it's worth far more than the currency used to buy it. The prices are wrong. They've never been allowed to reach full price discovery when you have the largest concentrated commodity, concentrated short position of any commodity of the 1,000 plus traded on COMEX for years. It just speaks to the why. Why would it be the largest short position in this tiny little commodity? It's not for these banks to make money, is it? Sure, they do, but is there something bigger behind it? And we've talked about that forever. So yeah, what we're witnessing right now is the inability of the players that have used the Western dominance, which is big checkbooks, big pockets of cash, to continue to suppress the price naked. It's now an existential threat.
Sovereign wealth funds and central banks are signaling that silver is no longer just a minor commodity. It's a critical mineral. China's moves, paying double market rates in Peru and Mexico for concentrates, reveal that the current price has been artificially suppressed. COMEX's historically massive concentrated short positions indicate systemic manipulation rather than natural supply-demand dynamics. As Andy Schectman highlights, Western institutions can no longer maintain control, creating an existential threat to their price suppression strategies. Next, we'll examine how these structural weaknesses are triggering outright market realignment and short covering events.
And you're seeing that. The rumor is the reason they stopped is there's one big trader who took possession and would not roll it over a stamp for cash delivery, perhaps an Asian trader who wanted over 400 million ounces of silver. Give it to me. And so, all of a sudden, the cooling breaks down over Thanksgiving in one of the most thinly traded markets of all. So there's virtually no activity, but just those servers broke down. Right. So the point of it is that this signals, just like the LBMA said, sorry, it's not L plus or T plus 1, it's T plus 8 weeks. Right. We don't have enough manpower or trucks. The Western system is crumbling under their own narrative and they are losing trust. And that ain't good when a system is completely built on trust and it starts to, as the water recedes, what's the old adage, you see.
Warren Buffett said when the tide goes out, you get to find out who was swimming without swimming trunks. Yeah.
Right. And I think that's going to be a grotesque picture before it's all said and done. And that's why I think you're seeing a different narrative unfold amongst these banks that maybe the game is over and survival would mean breaking ranks and covering and getting out. You see one of those European banks do that, and then the whole game just implodes as the price skyrockets and shorts get squeezed and they cover, pushing the price up higher. This is a big deal, and I think it's just beginning right now.
A single trader refusing to roll over a massive silver position may have triggered a systemic breakdown, exposing fragility in the Western paper market. With servers failing and delivery timelines stretching to 8 weeks, LBMA signals confirm operational collapse. Historical patterns show that when trust erodes, price discovery migrates, forcing shorts to cover aggressively, which can cause rapid spikes. As Andy Schectman notes, this could catalyze a chain reaction where institutional exit triggers massive squeezes, and we are only seeing the early stages.